Welcome, everyone. I'm Greg Schnell, the Canadian technician here to host the Market Buzz. This show looks at weekly setups across the U.S. market, and using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed for more information throughout the week. So, after our Wednesday down day, that was a little bit of an exasperation when we finally wrapped that up. We stabilized Thursday, and now it looks like we're trying to bounce. But one of the things that's interesting is on a couple of the markets, we didn't take out the prior week's low. So, we're definitely trying to hold this anchor point here. So today we're going to go into the put call ratio and why that might be telling us that there's a bounce coming. Late August, one thing that's interesting is the last 5 years, late August, we've had up markets from options expiration through to the 1st of September. And then typically it's not uncommon for a market to have periods of 6-week corrections. And so we've been pulling back since the beginning of August. So perhaps that puts us mid-September or something like that for our final low. But in the middle of those types of corrections, you can definitely have a couple of weeks that power higher as well. So we'll keep watching, but we're going to talk a little bit about the support levels being tested and about the banks and brokerage charts. And again, a world without banks and brokers going up is usually odd. So we're going to try and remain focused on that. Okay, so the first chart I wanted to mention was the put call ratio. And so the put call as of yesterday's reading was up at 0.975, call it 1. And one of the things that happens is when you get way up here, so this goes back to 2014, we saw it in late July. In 2015, we saw it in August, right at options expiration or just before it. Saw a couple of readings on the absolute low in 2016. And then we've had a couple readings in June. This one was in early November. And that early November low was kind of the final low from the election. It was actually a Fed low that we rallied for a week, and then we had the election and popped out of there. Then we had the 2017 April and August timeframes. There's that word August again. So you get these midsummer dips and coming down into here. And then that was a pretty spurious rally out. And again, we were testing support in that zone. Over in here, we were a little bit above support, but not a long way. And then currently we're testing this 145 level of support. So all of this adds up to me to kind of say at least be aware of the potential for a big market rally. Now, if you notice this head and shoulders topping structure on the Russell, which I think we've all seen that movie, what we're looking for now is just, does that play out to the downside? And if I go back and I look at 2007, I found this quite interesting. So I did the same chart, put call ratio. And what you see here is in the July timeframe, we pulled back and then we rallied up and then we kind of got stuck. I think this was options expiration in July 2008. And then that actually rolled over into the big waterfall. But what was interesting was, I would have expected this to be September of the year before, not 2008. So it was, the Russell held up very, very well through that whole housing situation in America back in 2007. And then obviously we had the Bear Stearns failure in May of 2008, and that pulled back the Russell just to support, and then a big bounce out of there in early July, which was quite interesting, and then came back down, and by October we were starting to fall apart. I'm not predicting anything below this red line. My bigger or anything that severe below this red line. My bigger point is that the global market is weakening. And one of the things that's surprising me on the charts this week is that the Shanghai is actually setting up quite nicely. And so if I just go get, there we go, dollar. One of the things on this chart and it closed up again today. One of the things on this chart is after pulling down below the 40 week, we're setting up with an inside bar, and you'll notice that we made our lows back in 2000, on the December lows, the same as the US market. We've rallied up and now we're pulling down. Um, the interesting part is we're right at the zero level here. So this is an important place to watch. If for some reason all of a sudden the market wants to start to rally out of here, that would surprise me a lot, but that doesn't mean it won't happen. We found support at the 40 week here in May, June, and now we've dipped below this 40 week, but we're having this inside week. And you can see the Shanghai's been down for about 6 weeks in a row. So I'm just watching it more from a perspective that we've come back to the zero line and reset. And if we were to bounce out of here, this would be an important place to watch. I've been very surprised that even on the week where the US market had such a tough day on Wednesday, the overnight in Shanghai was not nearly as difficult. So if we just go to a daily look, and we'll have to zoom in again. Let's go to 0 and 3 months or something like that. And we'll just widen out this chart a little bit and give us some room. And what we see here is, the rally down on Thursday. Obviously, it opened with a gap down, but look at the price action all day on the Thursday. And again, that would have been overnight on after the U.S. market had a big down day. So the Shanghai gapped lower, rallied all day. So didn't give up anything and actually closed higher than the prior day. And now today, I think in the overnight session, they closed up slightly again. So we're back near the top of the range, but just notice this momentum trend here. If we start to break that to the upside, I think that's a very positive, very bullish place to look on the chart. And if anything should be weak in my world, it would be the Shanghai in the middle of all these trade talks. So while we're quite enamored with the depth of the pullback and stuff, the Shanghai market surprised me this week to see it so, I'll call it optimistic, closing up higher than it did close last week, and setting up the inside bar. So watching the Shanghai just to see if there's any sort of clues there, and to see what we want to watch for. So this is the S&P 500 today, and the VIX is up here in the top. But we were testing this prior low back in here, and now we're making a higher low on the PPO. So even though we had that big down day and it felt like everything was bad, that down day ended up being the test. I think this was the down day, and then yesterday we tested slightly lower, and now we're rallying back up. But that, having that one kind of thrust down and immediately turning around and reversing off of the prior low for the S&P is pretty important. The NASDAQ actually held the prior low from the week before, and the Russell gave it up. So there's definitely weakness out there. I think the one thing that surprises me is on this double bottom here, we have a much higher low on the S&P. So I think this is a tradable rally, and I don't know if it's for the next 2 weeks or something like that. But we head into September 1st and then see if we've got anything going. But I'm very surprised with the Asian market and how well it's behaved. Now I realize Hong Kong's behaving differently, but even Japan held up better than I would have expected as one of the weaker markets in the world. So it was weak, and it's still still behaving as a weak market. But I think that picture is starting to solidify. So maybe there's enough here to get us to rally into the first couple of weeks of September. Now, you'll notice the US dollar's been on a railroad higher here for the last 4 days after sitting down at the same level for over a week. And that picture is quite odd. Just to see it behaving so well. So let's just go through all these charts from a bigger perspective. This is 2 months, 60-minute chart. And you can see the VIX was basically staying below this moving average, the 100 period 1 hour moving average. And then it literally jumped above, broke the trend line, took off to the upside, and now it's coming back down and it's testing this level. The S&P could come all the way back up to 2940 and still be fine. So that's another 80-point rally. 60-point rally just to get back up to there, and then that would kind of set up a double bottom test. And if we broke through that, then we'd expect roughly 100 points of upside, which would take us all the way back to the prior high. Now, here's your MACD with this higher low, and that's the kind of thing that I'm interested in. I'm very surprised to see it's held up so well in terms of momentum, but that to me suggests that I need to be aware of the possibility for this being a higher low, and it's clearly a higher low. Now the question is, does it break out above the previous levels in momentum? And if that was the case, we could probably have a really nice rally on our hands. Now, looking at the TSX again, the Canadian market held up, and it actually gets to the point where I keep thinking, the math is wrong on this thing. I got to go check it out. And what we find, or what I find, is usually when I'm that surprised by it, it either it literally breaks down very, very hard, or starts to find support and take off to the upside. Now, again, the market isn't anywhere nearly as diversified in Canada as it is in the US. But all of this bearish sentiment, and again, I mentioned it on Wednesday, that if we can start to rally with, terrible trade negotiation results and that kind of stuff, with weakening economies, Japan and Germany really struggling in terms of economic momentum. Their charts have already rolled over. At least that's going to give us an impetus for some rally. Now the question is, as an example, does the Russell get back above 1600 or something like that? Who knows? But the point I want to make is, without question, we've been falling pretty hard here. And if nothing else, we get an oversold rally, and we rally up and now start to see if we can make headway. But look at what's also going on gold here. We've got this big long uptrend, and I could probably extend this line straight out and just say, if gold starts to break down here and bonds start to break down, and let's just say that the bonds are pretty darn extended. If both of those started to break down kind of as a tandem, and just get past all of the talk about the 210 inversion and that kind of stuff, that to me would suggest that we do have enough here to get a rally going. And one of the notes I made looking through the charts was that oil seems to be just trending down slightly. It's not really gapping lower. Now, steel is gapping lower, copper is pushing down, aluminum's pushing down this week. A lot of the industrial metals aren't giving me any clues like that. But looking through just this chart list here, there's some things going on that are starting to make me wonder if we can rally. And the main reason for those thoughts is that, there's so much pessimism in the news. Usually we get some sort of backdraft. They're not going to let you leave your short position on easily. If you were short, it'll run against you pretty hard and make you make tough decisions. So I'm watching that very closely. Now we're going to cut away for a commercial break here in just a second, but I do want to talk about two things. I'm speaking at Golden Gate University in San Francisco on September the 14th. There's a one-day meeting there. And the TSAASF for San Francisco is hosting a one-day conference, and you can go to their website and find out about that. And then I'm also doing the Toronto Money Show September 20th, 21st. So if either of those can fit into your schedule, that would be great. And with that, we're going to cut away to a commercial, and we'll be right back.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Okay, and we're back. And as we can see here on this chart, this is the 5-minute chart of the S&P 500. And what we'll notice, obviously, is that we had this base kind of setting up for the last day and a half, and now we started to break out to the upside. And again, it's options expiration today. That's another reason to expect the markets to change or have an inflection point. I think for all of us back in December, you might remember that options expiration day was December 21st. We made the major lows on the market kind of the day or two later, and off we went from there. So always good to just be aware of when the options expiration date is. And just because we've been really thrust down hard, that put call ratio so offside, it does suggest to me that we've got some potential for upside. Okay. The second thing I wanted to cover off, or one of the other things I wanted to cover off, was housing starts today came in back below the 40-week moving average, and this chart will update later on. But we want to keep being aware of big indicators like this one. So it came in at 1.1197, and so 1.1 million. And when we look at that number, it's all fine and it's in the range of the last 2 years. I think what I notice is this seems to be slowing, and we're back below the 40-week moving average. Let me just turn off the inspect button. That's annoying me. But looking at this horizontal line, which I have placed right at the level of today's reading. So to me, that's one more thing that just suggests, the economy is getting sluggish here now. I know that there's some hope that in September we'll have some trade resolution, or at least some trade improvement in discussion and tone. And with that, that could carry the market higher. All of this adds up right here as this big flux point, and we, obviously can't see the future, but the real question is, as we're working through these charts, and I just want to go get one particular chart here. As we're working through, one of the things I'm noticing is the railroads continue to break down, and that is a caution flag for me. In November, December, they were doing the same thing. And what you'll notice is we had the big thrust down in October, and then we actually rallied for almost 5 or 6 weeks here, and then had another 3-week drop. So the drops were pretty quick. Sideways rally didn't really amount to much, but if you were trading through it, it was enough. Like, we're making a higher high this week, a higher high this week, slightly lower high, lower highs, lower lows, higher highs, higher lows, higher highs. So corrections are never easy. And again, we've been pulling down for a while here. The railroad's been going down for almost 6 weeks straight. To me, it's the bigger trend that's broken here. And so that's why I do think that we end up going a lot lower. All of my data continues to say that, but that doesn't suggest that now that we're coming through options expiration and that big Dow thrust down day on Monday or on Wednesday gives us the change or the reason to at least expect an oversold bounce on some of this information. So I still think the railways are one of the clues for us that things are weaker. Now, in the introduction here, I had talked about the support levels being tested. And again, I showed you on the Russell and the NASDAQ. So the NASDAQ 100, the NASDAQ Composite, and the S&P 500 have all held their lows, and the Russell and the Dow both broke their lows. So more still concerned about the Russell breaking down. But now, one of the articles I penned the other day, and we tried to talk about it on Wednesday, was the banks and brokerages. And then again, Wednesday finished up so rough. Those charts broke significantly. So if I just go get, I have to think about this XBD, $XBD. This chart was is one of the ones that concerns me. And again, it's pivoting off the 2016, 2018 lows, and we're now below the level, and momentum has gone below zero. Bankers below zero is not a place on the chart I want to enjoy. And you can see even in 2007, as it went below zero, it was like a bumpy ride down. It was not a smooth, just put on the short trade and live with it. It was a very roller coaster move down where you kept having these false waves up, and look at the full stochastic back then. It just kept rolling over at the 50 level, but each one of those would have been a 2 or 3 week turn, your PPO turning back up, and you're wondering, okay, is the low in? And then it rolls over, and it's the low in and it rolls over, low in and it rolls over. I don't profess for a second that it's going to be easier this time to try and get this right. Now, if we go look at the bank index itself, and I think I've got one of those saved, Dow Jones US BK, there we are. And what we see on the bank index here, this was part of the article. And what I was a little bit worried about was that I said on Wednesday that we had some space still on the bank index here, but it was this asset managers that had already broken. And that's the one I just showed you, the broker dealer index. And it broke down again below support. And this is the European banks. And again, that's one of the areas that I think really is in trouble. Now, we also have the Fed meeting in Jackson Hole next week, and with that meeting, usually what we get is the central bankers from around the world come together and talk policy. I cannot help but think a chart like this ends up on the front table, like, okay, the Europeans banking chart is very close to breaking down. The asset managers have already broken down, and even the US banks are just barely holding the trend line. There's a little bit of room there, but I think in general, that kind of sets the stage. So there's enough weakness to get central banker interest, and obviously, with the price action we've had this week, everyone from Mohammed Al-Arian, and I think even some of the more candid speakers have all suggested that the Fed will ease in September. So that almost seems like a given. The real question is, as we work through this cycle here, do things start to improve? And we had stuff like consumer sentiment go from 97 to 92. So a little bit of a slowdown on that. There's lots of things going on that are adding pressure. I want to show one particular part about the commodities market here. And so we're just going to go through the chart on the CRB. And actually, I'm going to go up 2 charts, and this is just to put a little bit of optimism in the world. This chart is starting to really be interesting. This is the Australian stock market compared to the S&P 500. And what you see here is at the bottom back in 2000, and the Australian market started to actually outperform. And one of the things I noticed this year was that Freeport-McMoRan Tech and Freeport-McMoRan and Tech didn't perform nearly as well as Vale and Rio and BHP. So you start to see these 2 big Australian miners, and they held up pretty well. They've broken down since, but they held up pretty well. And it's this base that built back here in the 2001 period that was a clue, and all of a sudden we had the big commodity run, and that went all the way into the final highs of 2011. To me, it looks like this is trying to set up. And if we go to the Toronto stock market, it hasn't broken out the same way yet, and it could be a difference between politics in Australia and Canada or whatever, but we're definitely pressing against this right side edge here. And if we get any sort of a turn on commodities, that would make me a little bit more bullish for big picture. And again, talking monthly charts, not a few minutes at a time here. And we see the commodities just trying to hold up in this lower level here. Obviously, so far we're at 170. We're trying to hold this 168 level from 2018 December, and we we blew through it to the downside this week. So we don't have, you know, I would say we're testing support on the commodities. And again, if all of them are going to break down, that would be a problem. But if we start to see some sort of an uplift, and let's just go to oil and gas. Here's the trend line on crude, and it's below its 10-week moving average. Natural gas is below its 10-week moving average, but you can see crude is sideways this week, considering the market had, so much down pressure on Wednesday. For crude to just be flat through that environment is quite interesting. Now, gasoline and heating oil both suggest lower for a while yet. They've both broken their uptrend lines, and while heating oil's paused this week, gasoline continues to drift lower, and that is never helpful. On the ag front, we also saw a lot of the ags, like, look at this corn sell-off. This is just crushing. And then when we got into soybeans, this is rolling over, wheat's rolling over. When I get into the gold, silver, they're obviously okay. It's the copper and aluminum. So here's copper going sideways for the last couple of weeks, but aluminum has rolled back over again, and this livestock keeps breaking down. Sugar and coffee don't really care about. I want to get you to this one, coal and steel. And one of the things, if we're going to start to see industrial demand, these charts should start to improve. And what you see is they're clearly breaking down to new 2-year lows, close to 3-year lows. The same thing for the steel ETF. This is the coal ETF. And so somebody's got to make these raw materials. And obviously, if they're going to continue to go lower, it's going to be much more difficult for the market to expect to have, I'll call it, economic swing start to turn back higher. So here's lithium, and this chart just continues to make lower highs, lower lows. That's the whole electric car battery and the future and all that kind of stuff. And here's rare earth strategic metals, and those continue to go to new lows. So we're just not getting the sort of lift across the industrials that I'm expecting. But it was things like crude that didn't get pushed down this week that gave me more optimism that was a place to start looking. One of the things I pointed out in a previous version of Market Buzz was that we have the momentum indicator on the CRB or on oil. Typically, when the PPO rolls over on that usually coincides quite well with a rollover in the stock markets, or when crude gets pressed lower, the stock markets kind of lose their push higher. And with XLE here, you can see we're down. We haven't quite made it down to the December lows, but we're getting to the point where things are starting to come under pressure. And this is the oil refiners, and they're starting to break down here. So that's not very good. I know there were some people on TV a couple of weeks ago talking about buying ExxonMobil because it has a nice big dividend, and that's just a great place to get on board. Well, that stock continues to break lower, and I couldn't help but think, you've taken a 10% capital hit to get a 3 or 4% dividend. So anyway, Pip is speaking tomorrow on Saturday, and you can watch that on StockCharts TV. So I want you to make sure you tune in for that. And thank you for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. And with that, 2 more things to remind you of, or 3 actually. San Francisco, September 14th, I'll be at the CMT Association meeting in Minneapolis on the Tuesday, and then I'll be in Toronto on the weekend after that. So thanks, everybody. Bye-bye.